Today, we're jumping right into a situation that, well, just a few months ago would have seemed completely unthinkable.
Unthinkable is the right word.
We're talking about Micron Technology, ticker MU, and it's just, sudden and decisive surge to a new all-time high. It closed at $294.37.
And that number, 294, that's where the paradox really starts for most investors.
Right.
You see an all-time high and your gut instinct, that psychological trap, it screams that the rally is over. You start looking for the pullback.
That's just how these memory stocks have always behaved.
Exactly. But the analysis we're digging into today argues that this thinking isn't just a little cautious, it's fundamentally wrong. It suggests the whole rule book for memory chips has been torn up.
So the story isn't ending, it's just beginning.
It's being completely rewritten, and that's our mission today, to filter out that emotional noise, the fear that comes with a new high, and really break down the math and the structural changes that are happening.
We're going to try and understand what points to a potential $400 valuation.
And it all starts with this concept of a supply shock.
Okay, let's start right there. What exactly is the supply shock the research talks about? Why does it change the game for a classic boom and bust cycle like semiconductors?
Well, to really get the shock, you have to feel the intensity of the market action. On December 29th, what the data showed was just remarkable.
What happened?
MU opened around 280. There was this brief little dip, some profit taking maybe, but it was just absorbed almost instantly. And then
the move.
It was a straight rocket ship, just a massive power move on enormous volume, closing at that $294.37 high.
And that's the key, right? The speed and the volume. Because normally at an all-time high, you'd expect to hit a wall of sellers.
A huge wall. People who've been holding on for years just waiting to break even or cash in a big win. That's the historical trap we were talking about.
So why was this time different?
It's about who wasn't selling. What we saw was huge institutional buying, just completely overwhelming that typical retail profit taking.
So why should you, the listener, care so much about this one specific stock? What does it tell us?
Because this is a perfect case study for the entire AI infrastructure build-out. Wall Street is waking up to a really fundamental, almost terrifying reality.
Which is?
When it comes to the high-end components that power AI, there is, and I'm quoting the analysis here, no memory left to buy.
Wow.
This shortage, this deep, persistent shortage, that is the bedrock of the whole structural shift. It's not a blip. It's a change in how these markets work.
And that leads right into the shocking catalyst you mentioned, the thing that's shattering the old rule book. For decades, memory was a commodity.
Absolutely. They'd ramp up production, create a glut, prices would crash, they'd cut back, rinse and repeat.
But not this time.
This time is fundamentally different. And what's so fascinating is the distinction. We're not talking about your standard DRAM, the stuff in your laptop. We're talking about a highly specialized component.
High bandwidth memory, HBM.
Precisely. HBM, specifically the new HBM3E and HBM4 chips.
Okay, so explain that for us. Why is HBM so different that it creates this kind of bottleneck?
Sure. Think of it this way. Standard DRAM is like a wide, flat highway. Good for lots of cars, but there's a speed limit. HBM uses advanced 3D stacking.
They stack the chips vertically.
Literally. They take 8, 12, sometimes more layers of memory and stack them right on top of each other, creating these tiny, super fast connections between them.
So it's about proximity, less distance to travel.
Exactly. It's proximity and insane bandwidth. This lets the memory talk to the AI processor, the GPU, at lightning speed. But, and this is the kicker, the precision you need to stack those layers perfectly is immensely difficult and slow.
So you just can't ramp up production like you could with the old stuff.
You can't. And that physical scarcity brings us to the timeline of the research, which is honestly, it's staggering.
This isn't a short-term problem.
No. These HBM chips are an absolute requirement for the next generation of AI GPUs. We're talking about NVIDIA's Blackwell and Rubin platforms.
And the timeline.
They're sold out. Not for next quarter. Not through 2025. They're essentially sold out deep into 2026.
Into 2026.
Which means this structural shortage is now expected to last until at least 2027.
That's a multi-year constraint just baked into the AI roadmap. That changes everything.
It does. And this feeds directly into Micron's competitive edge and its newfound pricing power. The research notes that right now, Micron has, and I quote, zero competition in this specific HBM segment.
Hold on, how can they have zero competition? What about Samsung, SK Hynix? These are giants.
They are giants.
Yeah.
But this is where that difficulty of 3D stacking really comes into play. The report points out that a major competitor, Samsung, is still struggling, big time.
Struggling with what?
With yields, manufacturing yields.
Let's pause there, because that's the linchpin, isn't it? Why is getting a good yield so incredibly hard with HBM?
Think about stacking 12 paper-thin layers of silicon. If even one of those 12 layers has a tiny defect, or the alignment is off by a few microns, the whole stack is useless. You have to throw it away.
So the failure rate is huge.
It can be. For standard DRAM, an 80% yield is good. For cutting-edge HBM, a bad yield might be 30%. If your competitor can only use 3 out of every 10 chips they make, they simply can't meet demand.
Which leaves Micron dominating the supply of usable, high-quality chips.
Correct. And that lack of competition gives Micron, as the analysis says, pricing power we haven't seen since the 90s.
Wow.
When you have demand locked in for years and basically no one else who can supply the product right now, you get to set the price. The old commodity cycle is just, it's irrelevant.
So the supply is locked up, but the big question for investors is, does the price reflect this new reality? The claim is that even at an all-time high, MU is statistically undervalued.
We have to look at the numbers in context. So the stock price is $294.37, market cap around $330 billion. And the PE ratio, the price to earnings, is about 28.
28. To a lot of people, that might not sound cheap for a big tech company. So why does the research call it dirt cheap?
Because a PE ratio is meaningless without growth. And this company is growing revenues at a staggering 60 to 70% year over year, fueled by this HBM demand.
That kind of growth totally changes what a fair multiple should be.
Completely. Now compare that PE of 28 to its AI peers, NVIDIA or AMD.
Right.
They're trading at 40, 50 times earnings, sometimes more.
So a PE of 28 for a company growing at 60% is a huge discount.
It's a severe discount. It shows the market is still pricing Micron like it's in that old boom and bust commodity cycle. The multiple hasn't caught up to the new reality.
The market is lagging the fundamentals. So what does that mean for the stock price if the market just corrects that multiple?
Well, the math is pretty immediate. The research calculates that if Micron just re-rates to a fair PE of 35, and remember that's still way below its peers, the stock price immediately goes to $365.
$365, and that's not even counting future growth, that's just a correction.
Just a mathematical correction based on today's numbers.
Okay, wow. That changes the perspective on this all-time high completely. Let's look at the technicals then. This idea of blue sky territory. What does that mean for how high this can go?
Blue sky territory is a really important concept. Once you clear a previous all-time high, like $294, there is no historical price resistance above you. There are no bag holders, no large groups of investors waiting to sell just to get their money back.
So the only people left to sell are?
The weak hands. The short-term traders taking a quick profit. But what the research highlights is that their selling is being just completely overwhelmed.
By the buyers.
By massive, sustained volume on the buy side. What you're seeing is institutional FOMO.
Fear of missing out?
Exactly. Hedge funds, large asset managers, they're realizing the structural story is real, and they're piling in. They're buying the breakout because they see that valuation gap is real and the demand is locked in.
So that conviction from the big money suggests a lot more momentum. What's the path forward then? What's the forecast?
The research lays out a pretty clear path. First, a quick test of $300. Probably this week. That's the next big psychological number.
And once that happens, the key is for it to hold, for $300 to become the new floor.
Absolutely. Once $300 is established as support, the path is clear to the $350 mark. The forecast suggests that's achievable by the next earnings report in Q2.
That's an aggressive forecast.
It is, but is grounded in that quantifiable valuation gap and the supply constraint. So the final verdict is pretty clear. This is a buy the breakout scenario. It confirms the supercycle is alive and accelerating.
And that brings the $400 target for 2026 into focus.
Firmly into focus. This is the moment the market finally starts to see Micron not as a commodity maker, but as an essential AI partner.
It's a staggering conclusion. So just to recap for you, the listener, the old predictable memory cycle is dead. It's been replaced by a structural, multi-year shortage of high-bandwidth memory, which is absolutely required for next-gen AI. That's what makes this breakout so important.
And if you connect this to the bigger picture, the fact that this shortage lasts until 2027 means that valuation gap we talked about, that low PE ratio, is based on persistent, verifiable demand, not hype, which raises a really important question for you to think about.
Go on.
When a core company gains this kind of technological scarcity and pricing power, the kind we haven't seen since the 1990s, what other stable market metric beyond just the PE ratio is the first to completely break down under that pressure?
That is a fantastic thought to leave with. The fundamental rules